Well, good morning or good afternoon, everyone. Welcome. We are here today to talk about some of the cash flow opportunities and considerations related to the CARES Act and other recent COVID-related legislation. Today we have Joe from our R&D practice, Adam from our pass-throughs practice, Mark from fixed asset services, and I'm Andrea Mao, and I'm in the accounting methods group. The topics we're going to touch on today are some of the CARES Act modifications to the Tax Cuts and Jobs Act, modified some of the unfavorable revenue raising provisions there and delayed the application so taxpayers have more opportunities to recover losses. Mark's going to talk about the Qualified Improvement Property or QIP correction, which is also a significant source of benefit to our clients. And then Joe's going to walk us through the ERC, the Employee Retention Credit, and then the other payroll tax opportunities, as well as some R&D items to consider. And finally, Adam's going to talk about everybody's favorite, the Paycheck Protection Program as part of the SBA loan. The CARES Act modifications to the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act in some ways limited the ability of taxpayers to take advantage of net operating losses. Taxpayers were no longer allowed to carry them back. They had to carry them forward. There were limitations on using business losses from pass-through entities or other sources to offset non-business income. So to use a loss from one business activity to offset significant portfolio or investment income. And then the corporate AMT was repealed as part of the Tax Cuts and Jobs Act. However, and the credits were allowed to be recovered over 4 years. That has now been accelerated. So taxpayers should be able to fully recover any of their corporate AMT credits by the end of 2019. The NOL carryback in particular is a significant source of interest for many taxpayers because it provides us the unusual ability to generate permanent tax savings with current period deductions. So as I said, the NOLs that are generated in 2018, 2019, and 2020 can be carried back 5 years. So they can be carried back to 2013, 14, and 15. And those were years before the Tax Cuts and Jobs Act, which means that for most taxpayers, they were subject to a higher effective tax rate in those prior years. For example, in the case of a corporation, they probably were taxed at 35% prior to the TCJA and are now only paying 21% tax after 2017. So what this rule allows us to do is use a loss that we generated in 2019 that may only be worth 21 cents on the dollar and go back and recover taxes that were paid in 2014 and 15 where my rate was higher. And effectively, as is illustrated here, for every $100 of loss we can generate currently, we can use that to achieve $14 in total permanent tax savings by carrying that back. One of the items taxpayers can use, or one of the tools that they can use to try to maximize losses, are accounting method changes, which is the area that I spend a fair amount of time in. And accounting methods are the rules that we use to decide when certain expenses or income items are reported on the return. So is this particular payment required to be included on my 2019 return or my 2018 return? Can I accelerate a deduction from 2019 into 2018 or 2020 into 2019 to try to increase an NOL that I can carry back? The other nice thing about accounting method changes, those that are eligible for automatic consent can still be filed for 2019. So if we could identify an opportunity related to an automatic accounting method change, we can use that to increase a potential 2019 loss that we can then use to go back and retrieve some of the tax that was paid in prior years. Some of the common areas where we see automatic changes are focused on areas where the book rules may be different from the tax rules. For example, in the area of prepaid expenses, book will typically capitalize and amortize all prepaid expenses, including insurance policies, dues, software maintenance, things like that. There are some opportunities for us to deduct those up front if they have a term of a year or less, so we can move a lot of those expenses forward on our tax return. Mark's going to talk about the depreciation and cost segregation opportunities. The depreciation rules for tax purposes are considerably more favorable than book purposes. We can depreciate assets much more quickly. Software development costs can be capitalized for book purposes and under certain circumstances could be deducted for tax. So those are just some of the things to watch for on your returns or your financials to see, hey, maybe I have some opportunity here to try to accelerate some deductions and increase a net operating loss that I can carry back. However, it's not all roses, and it's not always an easy determination whether the loss carryback is going to be a good idea for you. When we carry an NOL back, we have to recompute all of our prior year tax items from that year. So the Section 199 domestic manufacturing deduction that was in place until 2018, we need to recompute that deduction. We recompute our AMT, tax credits, 199A. Anything that was on the related return that we're carrying back to needs to be redetermined. And for those with international operations, there are some significant potential implications there related to the FDII and GILTI provisions from the TCJA, the transition tax under 965, foreign tax credits. And we found in some cases for taxpayers with multinational operations, they can actually lose out on permanent tax benefits if they're not careful by carrying back losses. So it's important to make sure you understand all aspects of your return and your tax liability before deciding whether the NOL carryback is a good idea. One of the other areas where a lot of taxpayers got caught under the Tax Cuts and Jobs Act were the interest expense limitations. After 2017, taxpayers can only deduct business interest expense to the extent of their interest income, 30% of their adjusted taxable income, and floor plan financing. So if your interest expense exceeds those thresholds, with adjusted taxable income is generally equal to an EBITDA, so it's your earnings before interest, taxes, depreciation, amortization. If your interest expense exceeded that threshold, you could not deduct it and had to carry it forward. The CARES Act increased that threshold for 2019 and 2020. So instead of being limited to 30% of your adjusted taxable income, you can now deduct interest up to 50%. There are some unique rules for partnerships that allow the 50% limit to only be used for 2020, but hopefully the way the rules are intended to operate is that it will allow the partners to accelerate the deduction of any disallowed interest expense from 2019. And Adam, a little bit later, is going to talk about some of the nuance with the partnership audit rules and how those play in, both with this provision and with the net operating loss rules and the QIP rules we're going to talk about today. The IRS has also granted taxpayers an opportunity to revisit some elections that they may have made. So under 163J, a real estate or farming business could elect to be exempt from the interest expense limits. This would allow them to fully deduct their interest expense regardless of how large the number was. However, they had to slow down the depreciation on certain classes of assets. And in the case of real estate businesses, one of the classes of assets required to be slowed down was qualified improvement properties. Mark is going to talk about it in a minute. So by giving up the potential for accelerated depreciation and bonus on those assets, now all of a sudden, if I can deduct more interest under the 50, if I can get all my interest under the 50% of ATI, I don't have to give up interest expense, and I get to accelerate my depreciation. So RefPROC 2020-22 provides procedures for taxpayers to either make or revoke those real property or farming elections. The challenge here is that this will require amended returns, unlike some of the other QIP correction mechanisms. So it's important to know what, the extent to which this is going to interact with your QIP change and how we go about implementing those. And with that, I am going to turn it over to Mark to talk through the qualified improvement property opportunities.
Thank you, Andrea. And for those who joined the call super early, rest assured that Adam has figured out his shirt issue. So I'm going to be talking about qualified improvement property. It's official, it got fixed. And for those keeping score at home, it's been a 2.5-year almost journey to get to this point. It took a pandemic to do it, but we have qualified improvement property. So what is it? Looking at the slide here, interior non-structural improvements to non-residential buildings placed in service after the building was originally placed in service. So it encompasses a lot. It does not include additions or bump outs or expansions, but anytime you make an improvement, to the interior of your building, you're probably doing something in the QIP space. What happened from the TCJA to the CARES Act? So the Tax Cut and Jobs Act made QIP official. They forgot to make QIP a 15-year item. So we always had QIP. We just had it at 39 years because of a drafting error. And that was a big drafting error because only property that's 20 years or less gets bonus. In the world we live in now, 100% bonus. So it was a big error and affects a lot of taxpayers. So the CARES Act came in and did a lot of good for many different things, and slipped into that was this 15-year recovery period. So that is retroactive to Jan 1, 2018, and is a very good thing, especially for taxpayers who remodel, renovate, or improve their existing properties. To note, and this is a big note, the IRS views 39 years as an improper recovery period. So taxpayers must change the recovery period on QIP assets. It's almost like, it is like the IRS is forcing you to take a beneficial deduction. And as it stands right now, that's essentially what they're telling us. Treatment of improvements, this kind of goes through a timeline of all the qualified, and it could get confusing. Back in the day, before the Tax Cut and Job Act, qualified leasehold, qualified retail, and qualified restaurant each were their own thing and had different treatments and different rules around it. What the TCJA attempted to do was simplify it and lump it all into QIP, and they successfully did do that, short of this drafting error. So they combined all these things, and now, if acquired after 9/27/2017, you see we get this 15-year recovery period. So right now, all other qualified items no longer are available, which is okay because they all got bundled, and now it's in this QIP, and it's all 15-year. The one space where this affects the most, though, is the qualified restaurant property. So just because QIP is back doesn't mean QRP is back. And why that's important is because under QRP, new construction, original construction, was able to get a 15-year 100% bonus. So keep in mind that QIP is just for improvements only. So that QRP has gone away, and any new construction, original construction, will have to be at that 39-year recovery period. For the 2.5 years where this was in limbo, it got the name as the retail glitch, because that's who it affected the most. Retailers and restaurants who were used to this 15-year recovery period all of a sudden had it pulled from under them. However, this QIP is all-encompassing, so it affects all taxpayers across all industries, across all buildings, and this is just a short list of the possibilities. It does not include any type of residential, so think apartments, condos, single-family homes, anything like that, rentals. It does not include that. Another thing to note is QIP must be made by the taxpayer. So we have a lot of situations where a taxpayer will acquire a property, and as part of that acquisition, they acquire certain improvement property, maybe a renovation that recently took place, or fixing up the HVAC unit, redoing the flooring, any number of things. However, it's not qualified improvement property unless they were the person or the taxpayer to do it. So while you can do a cost segregation on your acquisition and try to get lower life that way, you have to wait till you actually make improvements to the building you acquired to get into that QIP bucket. Another point to consider, will all costs associated with a renovation remodel qualify as a QIP? Likely no. So this is a great thing. No doubt about it. Anytime you make an improvement, you're probably going to have some QIP. Can you just lump everything into QIP? Not really. There's items like structural. If you redo outdoor windows, doors that go to the outdoors, HVAC units that sit on top of your building, and a couple other little structural items, concrete, masonry, might not qualify. So I would say from the renovations we see come in, we're finding still a good chunk, 80%, that get into this QIP bucket, but there's a 20% of those assets or that renovation that kind of get left out. So you still have to be thoughtful, but at the same time, you're going to get a great benefit looking back and capturing this QIP. And is it always best to take QIP? So QIP is a wonderful thing, but there might be circumstances where you don't want to do it. If you are thinking of selling a property and you want to avoid recapture, you might consider not taking QIP and seeing if it could qualify more as a repair expense. And that goes a little bit more to fixed asset planning. So we'll get into that. So what you're seeing here is a building life cycle. The 0, 5, 15, and 30 are years of a building. And then around in yellow, you'll see, you purchase it, you maintain it, and you do some refreshes, remodels, start to improve. And then at that 15-year mark, maybe you're doing some major renovations, maybe even expanding. And then when you get to that 30-year mark, maybe you're selling, maybe you are completely gutting it out or repurposing it. So where does QIP fit in? Well, in the green quadrant, like we discussed, you cannot take QIP. You have to be the taxpayer to put that QIP in. So when you're acquiring or building, really where the cash flow opportunities are coming in is really your tried and true cost segregation, where you're pulling out building components from the financial side into a shorter recovery period in personal property on the tax side of the house. So in a cost segregation, we might find 20, 30, or 40% of those building costs actually qualifies 100% bonus, which is a great thing. On the flip side, in the QIP, we're finding 70 to 80 to 90% of that going into 100% bonus. So as you go down to refreshing and remodeling and repairs and maintenance, financial gap and book, they consistently overcapitalize, maybe like a roof repair, HVAC replacement. On the tax side of the house, you don't have to. There are ways to increase your cash flow and get those down. So we go through that ladder and try to knock it down to a 0 life if possible or 100% bonus. And repair studies are one way to do that. Of course, you always pull out the personal property and cost segregation. There's partial dispositions. So if you renovate a part of your building, you can partially dispose of that piece when it was originally placed in service. And then QIP. So QIP really becomes another tool in the tool belt. If the goal is to take something that is building 39 year and make it as small as possible and get as much deduction in the current year as possible, then these are kind of the steps you go through: repairs, cost seg, partial disposition, and then QIP is going to be a really big one there. And then going through to renovations and expansions, again, looking at maybe even some energy incentives at that point, but really all the same players are there going throughout. So this main takeaway here is try to get that 39-year building to a shorter life or to 0 to gather that cash flow. And the beautiful thing about this life cycle is if you've already done one of these things, you already did a renovation in 2015 or you bought something in 2000, all these tools are available retroactively and are automatic method changes if you go back and capture all these things and get a nice 481 deduction on your current year and free up that cash flow. It's very flexible. Deduction, if it's there, it's yours to take. It's just a matter of finding it. So we'll go through 3 recent case studies or just examples really of what Eide Bailey is seeing with our client base and with taxpayers coming to us in this QIP space. So it really scales well. On top here, we have an entertainment company, large casino. They have some hotels with some of their casinos and restaurants, 20+ locations. And we were able to look at their fixed asset ledger all the way back to 2016. And I should note, in 2016, that's when QIP came on board. It came on board as a 39-year, 50% bonus item. It changed in January 1, 2018 as a 100% 15-year item, but still a great answer if you get a 50% bonus on 39 years. So we looked at everything, found a $50 million projected deduction in year one that they'll be able to recognize on their 2019 return. That project is in process right now. And then on the hospitality side, and a little smaller, more mid-range, a Nevada resort with multiple buildings on their campus did a renovation to their ballroom in 2019, a $1.5 million. So again, we looked at the fixed asset ledger. We looked at the whole history of QIP from 2016 to 2019, and not only found that renovation, which is going to be a large chunk, but found some other items sprinkled in. Did it all at the same time, and currently doing that project, and should get them about a $2 million deduction in 2019. And one we did already since the CARES Act, an easier one, a smaller one, is a senior living facility. They just underwent a renovation of their kitchen. Nearly redid everything in their kitchen. We were able to look at the drawings, the plans, the specs, the payment applications, the invoices, and in no time got them a $500K deduction in year one. So in all these, the takeaway here is QIP, it's low-hanging fruit. And it's been around since 2016, but really it's become something that's juicier now because of the 100% bonus in 15-year and because cash flow is so important today. So it's one of those things that we can look back, we can grab, it's worth the effort to get that low-hanging fruit because it usually shows pretty well and some pretty significant material deductions.
Mark, we had two questions come in.
Okay.
One question was, what about a tenant allowance for QIP?
That's a great question. So tenant allowances in general are always tricky because who owns what? I will say this, without looking at, and you need to look at the lease and who has the burdens of ownership. But short answer is this: if you are the owner of that tenant allowance and you are depreciating those assets on your return and the tenant is not, technically it would be an improvement to an existing property and it would qualify as QIP if it's interior, non-structural, and meets all those tests.
Okay, and then here's a question. This may be Andrea, question for you or
yeah,
Mark.
and actually this is our next section.
Okay.
They're just jumping ahead. I'm so excited about this. We're jumping ahead here.
Well, that's a great segue, Andrea.
Great, it's a perfect segue. So as Mark said, QIP now has a shorter depreciation recovery period. So for assets placed in service in 2018 and 2019, where we were depreciating them over 39 years, we are now required to depreciate them over 15 years and apply bonus depreciation if they are otherwise eligible. So how do we do that? There's two main categories of options: amending returns and filing 3115s. And the IRS in the RevPROC 2020-25 gave us a lot of options and a lot of flexibility, which is great and yet confusing and difficult to manage all at the same time. So in the world of prior year returns, if you placed in service QIP in 2018 or 2019 and you filed those returns, you can go back and amend those returns and take the additional depreciation. Similar to what we talked about with the NOL carrybacks, you will have to recompute the return. So taking this additional deduction may limit your use of other tax attributes in those prior years. And we can do this regardless of whether you have filed 2019. Typically, there's a restriction on how far back we can go to correct these issues on amended returns, but in this case, the IRS is allowing us to use amended returns for 2018 or 2019, regardless of what has been filed. The Form 3115 is an accounting method change. What that does is allows us to catch up the missed depreciation in the year we filed the 3115. We can still file 3115s for 2019, even if you have filed your return. If you have filed your return, we will need to amend the return and include a 3115 and file prior to the extended deadline, but we can still do it. We can also file a 3115 with your 2020 return. What that would do is it forces the catch-up depreciation through the tax return where we attach the 3115. This goes back to, do I want a deduction on my 19 return? Do I want a deduction on my 20 return? Do I want to go back and get it on 18? Where does it make the most sense for me considering all of the moving parts in this analysis? And the IRS also gave us an opportunity to modify some of the prior depreciation elections. So the bonus depreciation rules state that if you place in service property that's eligible for bonus, you are obligated to take bonus depreciation unless you affirmatively elect not to. So without an election in place, a taxpayer that placed in service qualified improvement property in 2018 that didn't elect out is going to be required to claim bonus depreciation on that property when it's placed in service and when we compute our 481A or amended return adjustment, unless we make an election out of bonus. Typically, late elections to avoid bonus and the revocation of those elections can only be revised through filing letter ruling requests, which is expensive and time consuming. However, for the next few years, we have the opportunity to modify these elections through either amended returns or Form 3115. So this adds another layer of complexity to our planning exercise to determine, okay, do I want bonus? If I take bonus on this in 18, that means I have no depreciation on this asset in 2019. Do I want that? Would I rather not do that and spread my depreciation over the recovery period because the loss does me no good? Those are all things that need to go into that analysis. So again, a situation where the IRS provided us with great flexibility and great opportunity, but which has compounded the challenges of making these determinations. And in general, these can be filed up to October 15 of 2021, except the amended returns for partnerships are subject to other limitations that Adam is going to talk about here in a second.
And Andrea, there was a question that came through, said, I think it's a question about a slide, but basically pre-2018 assets, QIP that were placed into service pre-2018, are they bonus eligible, or is it only assets placed into service post 12/31/17?
The pre-2018 assets that qualify as QIP are eligible for bonus. They're still 39-year property, but there was a special provision in 168K that allowed that category of property to be eligible for bonus, even though the recovery period was more than 20 years. So yes, the short answer is if you can meet the other requirements for bonus depreciation, that would also be pre-2018 QIP would also be eligible.
Excellent.
And then, all right.
Yeah. So just quickly here, so there's a nuance to partnerships. If generally speaking, there's a new audit regime for partnerships. It's called the BBA Partnership Audit Regime. It's from the Bipartisan Budget Act of 2015. The way it works is, Andrew, if I can get back to that, I guess I have control.
Yeah, sorry.
That's okay.
I think I did that.
The way it works is basically what you're forced to do if you're amending a return or if you're subject to an IRS audit, the adjustment is pushed through in the current year. So for instance, if you had a partnership and you had some QIP that you wanted to claim for bonus, the default rule would be, and let's just say it's QIP that you placed in service in 18, the default rule is you'd push it through in 2020. Not a good answer for generating cash flow because your partners then couldn't claim it on their return until they file their 2020 return next year. So there'd be a delay there of a year for the partners to access, if it's going to generate a refund currently or some type of NOL that could be carried back. So recognizing this and recognizing the importance of generating current cash, that was one of the whole points of this CARES Act, is there's a special rule for partnerships for 2018 and 2019 if the partnerships are subject to the BBA rules, which is this complex set of audit rules for partnerships. You can file an amended 18 or an amended 19 return if your 19 return hasn't been filed yet and claim QIP for that year. And what that'll basically let you do, or let the partners do, is obtain an immediate refund rather than having to wait until they file their 2020 returns. Only applicable for 18 and 19, not for years forward, but still, if you have a partnership, if you have an LLC owning some real estate, this could be a very useful rule. And the key point here is to make use of the rule under this guidance put out by the IRS, also per the statute, that the amended returns need to be filed before September 30th, 2020. So that date is fast approaching to make use of this. I guess if you miss that date, then you're back subject to the default rules, which would be a 2020 item that your partners could take into account in the next year. Question, Andrea, and I'll rely on you to help me here too.
Partnership had QIP in 2018, and both 2018 and 2019 were filed. The only option is the 3115 for 2020. No, that is usually the rule. You are correct. Typically, we have to amend a return before we file the subsequent return, but the IRS has waived that limitation in this situation. So we have the option to amend both of those returns still. We can choose to amend 2018 and amend 2019. We can choose to not amend 2018, amend 2019, and attach a 3115 to take 2018 into account, or we can wait till 2020 and file one 3115 to take 18 and 19 together. So this is some sort of Venn diagram, I think.
But it's almost a heads taxpayer wins, tails taxpayer wins. I mean, at least for these couple of years, very, very favorable rules. Congress and the IRS are trying to bend over backwards to let people claim their bonus as quickly as possible to generate cash flow.
Right, and they're understanding that the determination of the quote-unquote best answer is going to be a taxpayer-specific determination based on your facts and circumstances, and they want to make sure that regardless of what your circumstances are, you can still take advantage of this in a favorable manner. So yes, that's the good news. The bad news is I'm burning a lot of brain cells trying to figure out how to do this. And now I think we are turning it to Joe to talk about the employee retention credit.
Yes, thank you, Adam and Andrea. The employee retention credit is a provision that was a new credit that was passed as part of the CARES Act. So we're going to dive into that a little bit. The first thing I always have to say when we're talking about the ERC is that if for any organizations or employers claiming or taking the PPP loans, you are not eligible for ERC. So it's an either or type of thing with PPP and ERC. And with so many companies applying for and receiving PPP funds, that's deservedly gotten a lot of attention, and we'll give an update on that here in a minute. But ERC is a good second option if you're either not able to or didn't take advantage of PPP. One thing that's not in the slides that we've got a lot of questions on the last week or so, and we finally got some guidance from the IRS, is that for those companies that have decided to return their PPP loans, and I'm sure Adam will talk about this a little bit, if you decide to go down that route, the IRS has clarified that you would be eligible to then claim the ERC if you qualified under that provision. So here's a few basics about the ERC. First, it's a payroll credit, but it's refundable. So for all of the credits that are earned, you can take the immediate benefit of the credit now. You don't have to carry it forward and offset future tax liability. The maximum benefit is $5,000 per employee. So the numbers can add up fairly quickly. For those who are not good at math in their head, a company that had 50 employees that were eligible, and they could max out their credit at $250,000. So again, the numbers can add up fairly quickly. The first step is looking to see if you're an eligible employer. two different ways to qualify as an eligible employer. One would be, have you had either a full or partial suspension of the business due to a government order around COVID-19? And we'll talk about that particular test here in a minute. Or can you show that you've had a significant decline in gross receipts? And you do that by comparing the current, any calendar quarter in 2020 to the same calendar quarter in 2019. And if it's less than 50% of the gross receipts, then you would meet the gross receipts test. After you decide if you are an eligible employer, the next step is to figure out how many full-time employees you have. For companies with less than 100 full-time employees, and if you're eligible, you can take the ERC on all of the wages paid. If you're over 100 employees, you can only claim the ERC for wages that are being paid where the employee is not providing services. And again, the IRS has issued some guidance on that rule as well that we'll talk about here in a second. So a little bit more details. I talked earlier about this being a payroll credit. It's a 50% credit of qualified wages. Those qualified wages max out at 10 grand. So again, 50%, 10 grand is the $5,000 maximum per employee. You're allowed to take the wages, the Social Security wages that are paid, but you can also allocate the employer's portion of healthcare expenses. It's not just the wages, but healthcare costs as well can be stacked on top of that. A couple of key points. Tax exempt entities can qualify for ERC. This is one way. There's some types of tax exempts that we're not able to benefit from PPP, even if they're smaller. So this is one area we've been getting questions on and helping some of our clients that are tax exempt and weren't able to take advantage of PPP. There is no specific requirement to maintain a certain level of employment or payroll levels, and no overall dollar limit. It's really based on the number of employees and the wages that were being paid. So how do you get your money? There's several options for getting the cash. For those companies that need the cash right away, you can start to reduce as you're eligible for the ERC, as you're paying the wages that are going to qualify. You can then start to reduce your federal tax deposit by the amount of the anticipated ERC, and that includes all buckets of the tax deposit. So not just the employer taxes, but also employee withheld federal taxes and employee payroll taxes. You can start to reduce your tax deposit on those periodic payrolls. If you do that option, or if you don't do that option, if you want to receive an advance payment, let's say your amount of ERC you've earned is $50,000 and your federal tax deposit was $30,000 and you reduce it, and so you keep that cash. The remaining $20,000, you could file a Form 7200 to request an advance payment of that excess 20 grand. Or you could simply carry that, quote unquote, carry that forward to the next payroll and then reduce the next payroll by that excess that you hadn't claimed yet. Or, lots of flexibility here, you can do neither of those and simply claim the credit on your quarterly 941 filing. The credit for both Q1 and Q2 will be claimed at the end of Q2. If and receive a refund at that point. So I alluded to this earlier. There's like many aspects of the CARES Act, we've been getting guidance trickling in, and one of the main gray areas that companies aren't quite sure how to apply is the definition of when a business has been partially suspended. We won't go through all of the details here, but one main question we typically get is, hey, if I'm an essential business, can I still potentially meet the criteria of partial suspension? And the short answer is yes, you potentially can be partially suspended. The examples the IRS gave had an auto parts manufacturer that was an essential business, but if one of their key suppliers had their business suspended because of COVID-19 and weren't able to provide some of the key supplies that the manufacturer needed, there could be this sort of domino effect where the manufacturer, even as an essential business, could be partially suspended. Another example I think is helpful from the FAQs of the IRS released is even for an essential business or a non-essential business, if the hours of the operation have been limited due to a government order, that can constitute a partial suspension. So it's really a facts or circumstances analysis, and you know, several factors to kind of weigh whether operations have or have not been partially suspended. Some of the other FAQs that the IRS recently released talk about for those employers that have more than 100 full-time employees, is it an all or nothing? Can you take part of the wages paid to an employee if they were providing services for part of the time and not providing services for other parts of the time? And the short answer is yes. You're allowed to determine how much time an employee is providing services and take the credit on the wages above and beyond that. So in one example, in the FAQs, you had folks that couldn't do their full normal job function, were only working 20% of the time, but still getting paid a full wage, and the employer in that example was able to take the credit on 80% of the wages being paid to those employees. There were a couple of disappointments in the FAQs that were released. The biggest one is that the IRS is taking the position that for furloughed employees that are not being paid any wages, the healthcare costs that are being paid are not eligible for ERC. This goes directly against congressional intent. Congress has sent a letter to the IRS saying, hey, this is not what we intended. Employers that kept employees on their benefits during the furlough should be rewarded with the ERC. So it remains to be seen if the IRS will reverse course on that particular item, but something we're certainly keeping a watch on. Okay, just again, this sort of is a recap of some of the key criteria, so we won't go through this because of time restraints, but the bottom is not an all-inclusive list, but some industries that we're seeing questions on and some of our clients that are claiming the ERC. A couple of these, I have the parenthetical note about potentially qualifying. You know, I think banking, ag would be a couple industries. And again, for the most part, you know, most of the employers in these industries would be considered an essential business. However, you know, there still could be partial suspensions of operations, and depending on what jurisdiction you're in, what state you're in, or local jurisdiction, what kind of government orders are in place. So certainly something to kind of keep in mind and consider. And we had one question that came in the Q&A. Can you or can you not apply for the ERC if you did get the PPP $10,000 and are also hoping to get the loan? You know, I guess they're referring to the forgiveness. So the short answer is, if you received a PPP loan, whether or not that is forgiven, you cannot claim the ERC, unless the one exception would be is if you decided that you shouldn't have claimed or taken the PPP loan and returned the funds, then you can claim ERC. And then the other question is related to PPP, so we'll Adam address that one. But there is a question about, is the 50% revenue decline a black or white guideline? The short answer is yes. If we're looking at they do have, gross receipts do have to fall below the 50% level. Of course, with everything in the tax code, there's complexity around what the definition of gross receipts is. It's beyond the scope of this webcast, but we can talk offline if needed. Quick slide on the payroll tax deferral. So this is the provision of the CARES Act that allowed you to defer your payroll tax, the employer portion of Social Security tax, and pay that in 2 different installments, 50% at the end of 2021 and the rest at the end of 2022. So there's obviously interplay with the payroll tax deferral and some of these other provisions. Specifically on the PPP loans, the IRS has clarified that you can continue to defer your the payroll taxes until you get the notice of loan forgiveness. So you can, in a sense, take advantage of both of those until you get that loan forgiveness. At that point, you're no longer eligible to defer your 2020 payroll taxes. With the ERC, the IRS has also said that you're allowed to, until you determine the amount of the ERC, you're allowed to continue to defer payroll, the employer portion of payroll taxes. So good options and flexibility to get some of that cash now and retain the cash instead of paying it to the IRS. So it's essentially interest-free loan, application-free loan, right? By deferring that. Just know that, just make sure you're planning for those balloon payments, if you will, and have the cash on hand when the time comes. Finally, just from my side, I want to touch on R&D tax incentives. This is not a new provision. R&D credits have been around a long time, since 1981. This has traditionally been the largest of the general business credits. A lot of our clients take advantage of R&D credits, and just wanted to make sure that a lot of companies that maybe could be claiming R&D credits and have not been, maybe now is the time to take another look at R&D to see if this is a way that you can free up additional cash by reducing your income tax liability. There is some interplay with R&D incentives and some of the other provisions we talked about. First, they're for startup companies that are able to claim the R&D credit to offset payroll taxes. You can essentially, in terms of the stacking rules, you can claim that credit first against payroll taxes. And then if you, let's say you claim the ERC, you could claim both, and the ERC, since it's refundable, you get more cash by doing it in that order. Another provision that's come about recently is the extension of time to file refund claims. So for any refund claims from 2016 that were originally due on April 15th, that due date is now 7/15. So we have another couple months to determine, hey, if I should have taken an R&D credit in 16, you could still file a refund claim for 16 here in the next couple months to get a refund from that year. The other kind of interplay that Andrea talked about, the NOL carryback rules and how complex that can get. One of the considerations is there's a revenue ruling, Rev Rule 8249, that basically says you can carry forward a general business credit, an R&D credit, for example, from a closed tax year into an open year, as long as you couldn't have used or utilized the credit in that closed year. So if you're working through your taxable income in a let's say in a 2013, 2014 year, you've done the carryback, even though that credit that year would normally be closed, you could theoretically apply this, the doctrine of Rev Rule 8249 to then free up R&D credits to carry forward to open tax years. And then just a little kind of a reminder here at the bottom is there is potential impact by claiming some of these other provisions. If you're not, and again, I think Adam will talk about the current IRS position on being able to deduct expenses that are paid with forgivable PPP funds. But unless the IRS changes their mind on that issue, if you're not allowed to deduct the R&D expenses, that portion of your R&D costs would likely not be eligible for the R&D credit. So hoping for a change in that rule, but something to keep on our radar as well. With that, we're going to pass it back over to Adam to finish us up.
Thanks, Joe. And the one question that came through, Joe answered part of it on PPP eligibility. Joe answered the part, it's whether gross revenue, whether you have to do a gross revenue determination, a cut to gross revenue to be eligible for PPP. That is not in the statute. Nothing in the CARES Act talks about having to have a revenue decline. Nothing talks about needing to have another source or not being able to access capital from another source. But as probably lots of people have heard, we're expecting guidance soon from the SBA and the Treasury Department on eligibility for the PPP loan. So they may come out with rules that relate to gross revenue. They may come out with rules that relate to other things. So stay tuned. But there's nothing specific in the PPP statutory language that ties eligibility to a revenue decline, unlike the ERC. So just in the last couple of minutes here, the Paycheck Protection Program, just brief background. It was introduced as part of the CARES Act along with the ERC and these other provisions. It was an initial $349 billion appropriation from Congress. That was exhausted in about 10 days. So they came up with an additional $310 billion. And as of yesterday, I think there was still maybe another 100 billion left of that. So, you know, in total, 650, 660 billion, maybe 550 billion of it has been loaned out. It's administered through the SBA, but importantly, as probably everyone here knows, that the way you access the loan, if you need the cash flow right now, is you go to your local bank, your local lender. They're the ones that process the application and then work through the SBA. But for a borrower, all you would work with directly is your local bank. We have the statute. We have, I think now, 4 sets of interim rules that are basically regulations released from the Treasury to help us on it. We also have, I would encourage everyone to Google PPP FAQ. There's a frequently asked questions page. If you Google it, make sure it's a .gov web address that you're pulling up, not some other firm that's claiming to be the FAQ. But the important point there is there's questions every day that the SBA is posing and then answering. And for the most part, they're pretty approachable. They're not tax technical questions. And I think from a client perspective or from a borrower perspective, a lot of borrowers could work through those and you may find helpful answers. Just the way I think about the PPP program, you had the loan stage, which is the 2.5 times payroll, working with your lender to get the money, and then the forgiveness stage. And there's actually 2 sets of rules that govern both of these stages. But for the forgiveness stage, which is really what most people should be focused on here, so you needed the cash to maintain operations, to maintain payroll. The moment that those funds hit your account, or the moment the loan is originated, it begins this, what's called the covered period, which is the 8-week period for demonstrating forgiveness. And the key thing there is, if you want, most of our clients want the free cash. They don't want a loan. They could have a loan from another source. What they want is the loan, but they want it to get forgiven, the free cash flow. To get that, you need to demonstrate that you've incurred eligible expenditures during the 8-week period, during the covered period. Remember, that starts on day 1. So if you funded last week, you're already a week into your 8-week period and you have 7 weeks left to incur eligible expenditures. What are they? Well, it's payroll costs, it's rent obligations, it's covered utility payments. The unfortunate thing here is the Treasury Department and the SBA took an interesting interpretation of the act and said that 75% of your eligible expenditures during this 8-week period, if you want forgiveness, 75% has to go to payroll. Nothing in the statute says that. All the statute says is there's buckets of expenses. As long as you spend your money on one of these buckets or a mix of these buckets, you qualify. SBA said, no, we want you to maintain payroll, so 75% has to go to payroll. So that should be immediate planning for anyone there who's been funded. You should be thinking about, how am I going to meet that? And what that means is, probably if you've laid off people, it's bringing people back onto the payroll as quickly as possible. You know, unfortunately, even if you're not operational, it could mean just paying people to stay home. The nuance that Joe referenced was that the CARES Act states that when the loan is forgiven, or the amount of loan forgiveness that you're eligible for, that does not represent taxable income. And that's a exception. And usually for federal income tax purposes, a loan on the front end from a bank is not income because you got to pay it back. But if you're relieved of the obligation to pay it back, that is income. The CARES Act was silent, though, in regards to whether eligible expenditures, these expenditures you occur during the 8-week, are deductible or not. I would have assumed maybe that it could be deductible because pretty clearly Congress intended for there to be a tax benefit, not to be a tax detriment when the loan was forgiven. But the IRS, and it's, as I always joke, in its infinite wisdom, decided that existing guidance and existing case law, and they're maybe right, I make fun, but they're probably right, that the tax expenditures are not tax deductible. And the reason why is because it's basically free money to you. You're not on the hook for the money. So the expenditure shouldn't give rise to a tax deduction. It's curious because it negates we have an example here, it negates the tax benefit of the forgiveness. And the quick example I use is two scenarios. One, let's just assume you borrowed 100 grand from a bank. You used 100 grand to incur expenditure. So you borrowed 100 grand, you spent 100 grand on payroll, which is tax deductible, let's assume. And then for whatever reason, the bank forgives the loan. You went bankrupt or something happened, the bank forgives the loan. That would produce $100,000 of COD income, cancellation of indebtedness income, in a year, but you'd also have the offsetting payroll expense. So it would be a wash, and I'm simplifying it, but if this all happened in the same year and it was all business related, it would be a wash to you, which makes sense. You borrowed the money, you expended the money, it's a wash. In the PPP world, by Congress making the forgiveness not taxable, you would have assumed that it's not a wash. You would have assumed that in effect, there's a benefit to be gained, a tax benefit to be gained, because Congress provided an exception to the normal rule. But by denying the deduction, in effect, they are putting you in the same place that you would have been under the normal rules. Because yes, if you have a $100,000 PPP loan, not income when it's forgiven, but you have no tax deduction, so it's again a wash. So it's interesting that that's the tact they choose, because in my view, it negates tax benefit. Congress pretty clearly intended there to be a tax benefit. Maybe Congress just was not articulate with providing the deduction side of things. There's a movement in Congress right now to fix that. So don't at all be surprised if there's a fourth stimulus bill here. They may provide that PPP expenditures are deductible. We hope so. But for right now, that is the rule. Are there reports that need to be submitted for the PPP or SBA? There will be stuff that, for the forgiveness side of things, we don't know what that's going to be, but you're certainly going to have some documentation to demonstrate your eligible expenditures and to get your loan forgiven. So stay tuned for that. Incurred and paid, good question. There's both what I would call, and this is where Andrea is it's where we need the smart person here that knows accrual language, but there's accrual language and cash basis language in the statute. So it's unclear whether you can accrue eligible expenditures or whether they just need to be cash basis, meaning that you actually just have to demonstrate cash left your bank account. That answers both those third and the fourth. And then lease payments on equipment paid in the covered period. We're not sure. That's an open question on that, because the reference to rent, we don't know whether that's just rent of real property or whether that's leasing of equipment. And need-based, yes, that's to my point there, the question earlier to Joe about the revenue decline for the ERC. We are expecting guidance soon, hoping to illustrate what it means to need a PPP loan. Unfortunate that they're dropping this after a whole bunch of people have borrowed money, but that's where we sit right now.
And Adam, probably important to remind everyone, they extended that deadline till the 14th, right? To kind of make that determination.
Yeah, great point. They have you may hear people talking about a safe harbor. I think banks have even sent around a memo saying to meet the safe harbor, you need to return your money. Originally, that was May 7th. They've pushed that back to May 14th, meaning if you're not eligible for the loan, you can return it by May 14th without penalty. I would say don't do anything. If you're a client with PPP money and you're worried, don't do anything yet until we're going to have this additional guidance. They promised us to have that guidance before May 14th. So wait for that additional guidance, and then you create an action plan at that point. 6-month loan forgiveness and SBA loans. I don't know. Is that referencing general SBA loans? I don't know if anyone else, in Andrea or Joe or Mark. Usually loan forgiveness is taxable. I don't know if there's anything unique about the SBA program generally, non-PPP related.
Not that I'm aware of. I think the PPP loans are the only ones that are exempt from the taxable income requirement.
So
the Main Street loan program, I don't believe is.
Yeah, or like the other loans through the SBA or the EIDL loans, EIDL loans, those are not forgiven. Mm-hmm. So that you have to pay those back. So I guess if they were forgiven, again, because you went bankrupt, it probably would be taxable income.
Unless you can qualify for an exception under 108.
Correct.
Bankruptcy, insolvency. There's a handful of exceptions there, but that's what you'd have to do to avoid paying tax on that.
That's why in my example, it's a very simplistic example that I put there about the 100,000 of forgiveness and the 100,000 of deductions, just to kind of illustrate a point. But Andrea is exactly right that anytime you have COD income, it's layers of complexity. And Joe, there's no, I've had this question, Joe, come up from people that there's no harm to waiting. So now that we know that if you return your PPP loan, you can get the ERC, you don't lose anything on the ERC by waiting to file a credit claim, right? That
Correct.
if you wait a week or two.
Yeah, you could, I mean, in an extreme example, you could even wait until the end of the year and amend your Q2 941. So you have plenty, I mean, obviously getting the cash gets pushed out, but you have plenty of time to figure out the details on ERC.
I've had that question from a few clients that they're going to maybe return their loan and they just want to know if they lose out in the ERC, and the question's no.
Sounds good. Well, thank you all so much for attending, and thank you to our presenters. We will get you a copy of this presentation and those links that Adam was talking about. We will get that emailed out as soon as we can. So everyone have a great day.